Good morning and welcome to Sound Money Management on Connect FM. I am Jay Filippone along with Chuck Johnson of Guardian Planners. Chuck, it's good to see you again as always.
Good to see you, Jay.
All right. Today we are going to talk about required distribution for retirement accounts, aka RMDs, right?
It's exciting topic, Jay.
Yeah. Fundamentals, misconceptions, strategies, all that kind of stuff, right?
I get asked a lot. This came up from client meetings recently. My clients are aging. I don't know how that happened. Some of them are getting older. I heard
we're getting younger.
Lori said in the intro that I've been doing this over 38 years it's been. I started when I was 10.
Mm-hmm.
So, but yeah, some of my clients, some of them are hitting that age. So I thought, since we had a lot of questions, I thought I would just do a show on it because if we're fortunate and blessed, we are going to hit that age. We're going to have to.
So disclaimer here.
Sure.
All right.
Disclaim it.
Remember, this program is for general education only, not individualized investment, legal, or tax advice. Not a recommendation to buy, sell, hold, roll over, or convert. Rules and circumstances can change. Consult qualified professionals like Chuck.
You did that really well. Yeah. You might have a career in this industry.
Yeah, doing it for a few years.
In a while. So let's just say what an RMD is and maybe how it's calculated. It's a minimum annual withdrawal that's generally required from tax-deferred retirement accounts after the applicable starting age. So the basic formula is you take the prior December 31st account balance, so you get your statement at the end of the year, your December 31st statement, and that is the base number that they will use for the following year to calculate your required minimum. So you take that number from your statement and divide it by the applicable IRS life expectancy factor.
Which is what? Do you know is it like?
It's a table. It just has, got the ages and then what they call the divisor, the number you divide your account balance by to determine how much you have.
Well, the reason I ask is the expected age for men in the United States has been down a little over the last 10 years.
Yeah, a little bit. Yeah, I read that. That's not good for us, Jay.
No, it's not good at all.
It's called the Uniform Lifetime Table, and that's what most people will use. You can Google it. It's out there. It doesn't really change. It is what it is. The number is the number. Basically, simple illustration. Let's say you have $500,000 in your IRA, and you look at the table, and your divisor is 26.5. You divide your 500,000 by 26.5, and that's what you have to take. Every year, that divisor gets smaller and smaller, so that you're taking out more and more. Your RMD, all things being equal, assuming your account balance stays the same or grows, the RMD will get bigger. Eventually, the idea is they want you to deplete the account. Uncle Sambino wants his cut. You've been tax deferring that for a long time, Jay, and it's time now to pay Uncle Sambino.
I remember there was a member of Congress, you might remember him from Massachusetts, that said, we got to get in and tax those accounts one time. They're making all this money and nobody is paying taxes on it.
It's terrible, right? Terrible.
I thought that was the point.
That is the point. One thing to keep in mind about RMDs is they are age-driven. And recent legislation has, believe it or not, muddied the waters a bit. I don't know how that happens. The legislation can cause trouble, but it seems to do that sometimes. Not everyone has the same starting age now. Used to be, and this is real simple, you had to take your RMD by April 15th of the year following the year you turned 70 and a half.
Right.
Okay, well, why couldn't they just say, you turned 70 and a half, pay your RMD? No, it's April 15th of the year following the year you turned, it's just complicated. They can't do anything easy. Well, they changed the laws, and now if you're born between 1951 and 1959, generally, at age 73 is your new RMD date. Remember,
so if you're born the end of 59, you lucked in, but if mom was a little late delivering and you came 1st or 2nd of January of 60, then you got to pay more, right? Or pay less.
They extended the age. So if you're born in that trend, anybody born after 1960, you can go to age 75 before you have to start taking it. the idea was that people were living longer, and they're trying to. This actually, they had good intentions. They're trying to extend the deferral time for some people, so you don't have to start taking it till you're age 75. And again, earlier birth years are governed by earlier starting ages. That's 70 and a half that we all would remember. But again, I want to emphasize this is age driven. So traditional IRAs, SEPs, SEPs, simplified employee pension, maybe you have that at work. Simple IRAs, anything like that generally require RMDs, even if you're still working. So it's not event driven. So I retire and I'm taking an RMD. It's age driven. So if you are in your 70s currently and you're still working, there are people that do that. You still have to take your IRA distribution, your required minimum distribution. Now, if you have a plan like a 401k with your current employer and you're over your RMD age, you don't have to take from that plan, but you do have to take from, if you have an old 401k from a previous employer and you're not working for that person or company, you have to take from that one. So the rules get a little murky. That's why we always say consult a professional. You don't want to get in trouble by not taking your RMD. We're going to cover that here in a little bit.
So quick question here. If I have an IRA from a previous employer, is it better to roll it over, or is it better to have the two separate when it comes to RMDs?
When it comes to RMDs, well, it's easier if you have consolidated your accounts that are required to be taken. So if you have accounts that are under the RMD rules, it's just easier. There it is. It's right there. That's my IRA.
Right.
Because the rule applies to all of your IRAs. So let's say you have 10. You've got a couple of old 401ks. You've got an IRA with this company. You got an IRA with that company. Well, December 31st, you have to sit down and aggregate the balance on all of those IRAs to determine how much you have to take out per year. So the more you have, the more complex a sometimes complex question can become.
And do RMDs apply to Roth IRAs?
Not generally to the original owner.
Okay.
But if you inherit a Roth IRA, there are distribution requirements. Can be. So yeah, Roth IRAs may fall under RMD requirements. It's rare, but it can.
Yeah. Another it depends, right?
It depends. Yeah, that's my whole industry, Jay. It depends. So I'm going to cover some myths regarding RMDs. And again, some of these are questions that came up when we were having client meetings. And here we go. First one: all Roth accounts are permanently exempt from RMDs. So the truth is, the original owners, as I mentioned, generally have no lifetime RMDs from Roth IRAs or designated Roth 401ks or 403b accounts under current law. Remember, these laws can change.
Yes.
Current law.
Yeah, they do.
There are no RMD requirements. But beneficiaries might, as I mentioned, face distribution requirements. A Roth label does not automatically make every withdrawal tax-free. How can that be? It's a tax-free account. Well, let's say you inherited a Roth IRA, but the person you inherited from didn't have it for at least 5 years. The earnings from that account, not the principal, but the earnings from that account, I would say principal, the original investment, would not be taxed, but the earnings may be. So there are situations where you may pay taxes on even a Roth IRA. Again, consult with a professional. This is a big one. The custodian is responsible for any mistakes. It's kind of like when you get your taxes done. If your CPA screws up, makes a mistake, you sign the tax return, send it in, and the IRS comes calling. They're not coming after your CPA. They're coming after you, right? If you forget to take your required minimum distribution or you don't take enough, they're not coming after your investment professional or your CPA or anybody else. They're coming after you. So you are responsible for any amounts that are required to be withdrawn and any deadlines that are required because of that. So again, consult professionals, but you realize you're taking responsibility for that.
Do most brokerage houses send you a notice that says, hey, it's time to take your RMD, or RMD needs to come out this year?
Again, it's custodian specific, but
so good to know then. You shouldn't always expect the company you're with to take care of that or remind you?
A lot of them do.
Mm-hmm.
I have one that refuses to. They will not do I don't do business with them. I did years ago, so I have some legacy accounts, but they will not calculate the required minimum distribution. They leave it up to you. So they want to get involved in it, which is kind of weird. Most custodians will tell you the money that you have with us, based on your age and the amount that you had with us on December 31st, here's what we think you should take. Basically, they're not guaranteeing anything. It is up to you. One large IRA withdrawal covers every retirement account. Another myth. Traditional IRA RMDs are calculated separately, then may generally be aggregated across your qualified accounts. And you can do similar things to 403Bs to aggregate. But a 401k RMD generally must come from that specific plan. So let's say you have 5 IRAs and a couple of 401ks. You may have to take a distribution from the specific 401k.
Oh, really?
Yeah. You can, now if you have 5 IRAs and you don't have a 401k, right? All you have is IRAs. You can take from one, as long as you take enough to satisfy the RMDs from all of them. Again, Sam Bino just wants his money, right? He wants his taxes. But if you have a 401k, you may be required to take a distribution from that specific account. Again, consult a professional. Taking extra this year prepays next year's RMD. That's a myth. The RMD has to be taken in the year that it's owed. So let's say your RMD is $5,000 and you take $15,000 out of just 1 year. Guess what? Next year you got an RMD again. You got to take every year. You have to take the RMD, even if you took more in an earlier year. You cannot take them in advance. The first RMD is always due December 31st. Well, the first RMD may generally be delayed until April 1st of the following year. Later RMDs are generally due December 31st. But here's the trap. Let's say let's say this year is the year that you would take your RMD. You could wait. So you turn 73 this year, and that is your age, right? Based on the current law. The current law.
Not my age.
Not
this is hypothetical.
Hypothetically speaking, Jay. You don't have to take this year's until April 15th of next year. However, you will still be required to take next year's RMD. So now you have 2 RMDs in one tax year. Sometimes, let's say you're still working and you've got income this year, but you're going to retire before the year is up. Might make sense to skip the RMD this year and take 2 next year. Again, you might be in a lower tax bracket, depending on the situation. Again, all of these are individual questions. You can't just give a blanket answer to these kind of things because everybody's different.
Right.
If you are working, you may want to defer and go ahead and pay tax on a double RMD hit in that first year. Maybe not. It all depends. At Guardian Planners, we can run the numbers, help you calculate that. When it comes to tax things, though, specific, so I can give you an idea. I always recommend that you discuss things with a CPA. I focus on investments and I have a general knowledge of tax issues. CPAs, some of them might talk to you about investments, but they're specifically focused on tax issues. That's what they do, and any changes, they're going to be the first to know. So anything like that, I always defer to your tax professional. But generally speaking, you got to be careful. You don't want to maybe not want to wait till April 15th. An RMD can be rolled over or converted to Roth. So an RMD is not rollover eligible, and it can't be converted. In an RMD year, the RMD generally must be satisfied before additional Roth conversion. So let's say you are converting to a Roth, you have to take your RMD first, and then you can take additional contributions out and roll them over to a Roth. But you can't do it directly. That's a no. You can't do that. And finally, in our myth category, missing an RMD is no big deal. I'll just go ahead and take it the next year.
That doesn't sound like a good idea.
Sam Bino wants his money. Say that over and over in your mind, folks. Sam Bino wants his money. That'll help you with a lot of these RMD questions. There is, in fact, a 25% excise tax on the shortfall, and So if you were supposed to take $10,000 and you didn't, they will, and then you do take it, you're going to pay tax on the 10, and if you're late, you could pay as much as $2,500 excise tax.
Follow the rules.
Follow the rules. Follow the rules. Now, people make mistakes, especially around the first RMD, or if you maybe you made some changes to your IRAs and you just forgot, you just missed it. If you self-report and you go to your accountant, CPA, whoever, and say, "Whoops, didn't take the RMD," sometimes they'll reduce that to a 10% penalty. Just
Okay.
So some leniency there. But the important thing is to make sure you take them, and if you miss it, immediately, like, do it before it even happens. Contact your tax professional and say, "Oops, here's what I did or didn't do. Help me," and generally they will help you out. All right, coming up, we're going to delve into some some strategies. I had a rough night today. I didn't sleep well. Woke up with a migraine.
Well, you still got it.
I still got it. But the show must go on. We are here.
Go on.
So we're going to delve into not some strategies that may be available to help you make the most of your retirement dollars. Don't go away. We'll be right back. Strategies.